What's up, guys? Welcome back to Zodiac Trading. So today our topic would be, related to the bond yield because right now the entire Wall Street and the financial markets' main concern is that the 10-year Treasury note touched a new high, which is 5% for the first time since 2007. So I said, in a previous video, I said that, I'm probably gonna short bonds, and I said it in the beginning of this year, based on several assumptions and several of my takes. So first, that I've said it repeatedly, and from the very beginning of this year, I said there is no foundation or whatsoever for the Fed to reduce the interest rate right now. And I don't see any chance for the Fed. At least the Fed is probably going to pause raising interest rate, but I don't see how the Fed will quickly end its raising Fed rate and then turn into rate like reducing kind of scenario. So I don't see that happening for an entire year. At least for next year, I still do not think there is any standpoint or whatsoever for the Fed to reduce its interest rate. And that might be harsh for most of the financial institutions because I think most of the salesmen from the investment banks or whatsoever, or these people, they're all saying that rates will soon be back and back to drop, and then inflation is going to be tamed back to 2%. And we don't see none of these happening, and the second stand, my previous stand was that I strongly suggest that the Fed, like the U.S. inflation rate, is going to hit bottom and then it's going to rebound back to another high. So right now we're seeing the U.S. inflation going back to 3% and then bounce back to 3.7%. And that figure remains till now. So a lot of people have been saying, oh, the inflation is going to be tamed, the PC got controlled, and everything is fine. So that inflation is going back now. It's going to be back 2%. So that's why the Fed is going to exit its restrictive policy, and we're going to see the rate lowering, and we're probably going to see another quantitative easing or aggressive easing. So I highly suspect that's going to happen. Okay, and I don't see that will be happening anymore. And I still think that inflation, 3.7% inflation, still low. I mean, given by the fact that we have Ukrainian war, we have Israelite war, we have all these regional conflicts. So for every investor, it's key for them to really identify the geopolitical risk and to understand that inflation is not going to, it's that risk is not going to be replaced, or that risk is not going to be reduced anytime sooner. Okay, so my third stand was, and that I think that the bond market has liquidity crisis similar to what happened in 2019, and it is mainly because right now the U.S. has a pretty much very chaotic situation. Um, you have Democrats and you have two parties trying to fight for its maximum interest, and the Democrats and all these people, they are just uh, risking the America future because they're trying to throw each other the debt ceiling, right? This debt ceiling stuff. So that just keep going, because next time, if GOP is not happy with like Democrats, they will do it again. They will just test. They'll just use that debt ceiling to force Democrat to do what they want. Okay, so it's insane. And right now, the financial market should be aware this could be a long-term risk, right? So the debt ceiling really doesn't matter. What matters is the uncertainty that expressed solely because of the debt ceiling policy. Because you have a stupid debt ceiling policy that everyone is so afraid that the government will shut down, right? And you will have a not a healthy, functioning financial market because of that. So that debt ceiling crisis, that kind of constant thing, that you have to, keep going for a couple months, probably a year, and then your enemy got you in a debt ceiling, so you have to renegotiate all the terms, renegotiate all the policies until you get another debt ceiling, until you get another deficit raise. I mean, that is truly the problem. So that's why it's going to affect the short-term liquidity of the bond markets because you'll be issuing a lot of short-term debt. You'll be issuing a lot of short-term bonds. That's the problem. So that was saying 2019 we had the repo crisis. Back then we have a lot of companies trying to liquidate their debt. They're trying to liquidate their corporate debt. So that's what's happening with the repo crisis. For now, we are seeing that 10-year Treasury bond yield hitting a new high, and to sum everything up, then I think right now the 10-year bond yield is not reaching the top. I think it's going to keep going up because that just reflects the truth. Right now, we do not have a QE anymore, so you do not compare the Treasury yield, back to the QE age, QE phase, because a lot of people have these routine reliance. They think that the QE has last for decades. We had a ZIRP. We had a zero interest rate policy for quite some time. We have nearly a decade or two, and that's a problem. And it got everyone thinking that it's going to last, right? We cannot live without that the interest rate going up above zero, that the financial bubble just keep growing and growing, and this diversity problem just keep growing, and most of the financiers don't really care about that. Once they get, because you have zero interest rate or semi-zero interest rate, quite crazy zero semi-interest rate, what you do is every time you try to pay back a debt, you do all these refinancing. Why? How do you do refinancing? Because the interest rate is extremely low for commercial banks, for financial institutions, for big corporations. You're using free money. You can leverage that free money. You expand your business by leveraging that free money, essentially speaking. And the US is paying back almost nothing by issuing more debt because the bond itself has very low yield. So you do not pay back as much as what you used to do. So, but there is a very important condition to do that. You need to have a developing country like China or India that can be able to provide you with an extremely cheap product and an alternative. I would just say that you'll be able to reduce that kind of cost because you're buying extremely cheap products from emerging society and countries. That's how you keep this monetary game playing. For now, the US and China are having very intense relationship. So we all know why. And now the biggest problem for the US is that you have a liquidity crisis, you have a deficit problem, you have a growing GDP debt, and then you have a abnormal China and US relationship. And you cannot, it's that inflation would just go high. In a real society, the tuition fee go up, the medical fee goes up, right? And the house would go up, and everything go up, except for your salary and your income. So we're talking about a potential reset, which I will be covering that very important concept in the next video. I'll be discussing about these financial reset, what it really means to ordinary people. But right now, the 10-year bond yield will just keep going because we get used to the fact that we have extremely low bond yield and we had a very low interest environment. And right now we need to stop imagining that phase. We need to stop to look back. We have to realize the paradigm of the market dynamic has changed dramatically. Okay, so that's the case, and because of right now we're facing uh, the uh, the Israel to Palestine kind of war. So that war will just keep going, because you have like many different parties in this area. They are trying to challenge the global order. They're trying to challenge the U.S. order. As we all know, U.S. has strong strategic interest in Middle East. So Israel is one of the very important ally for the U.S. But right now, you have Hamas trying to do these brutal and we just call this monstrosity kind of thing against Israel. I've been saying this for a long time. Like Middle East is a dynamite. It's a bomb, right? It's a ticking time bomb. If for everyone, because the Arabic, the very aggressive kind of Arabic, try to kick out the Jewish people. I won't say it like everyone's going to do it. So I'm going to say that people who are really aggressive, people who are extreme leftist, these people are going to try to kick out the Israeli, and there are more people trying to take out Israeli than more than having Israelite people trying to kick out but Palestine or Arabic people. These people could go alone, but the problem is they have too much hatred. And right now, the situation is gradually get, I think, out of control because recently we're seeing the U.S. uh, adding extra bill on the entire the operation. So that means the entire region could have more geopolitical conflict. From so on top of that, I think global investors should be aware that the war could be constant thing. It won't be like just finish very quickly. It could be like Ukrainian war. So we need to pay attention to that. So thank you guys for watching for this episode. If you guys like my content, please subscribe and share to your friends, especially in this moment of darkness. We need to carry on and we need to move forward. And thank you guys for watching. I'll see you in the next episode. Goodbye.